Hello everyone, this is Beast McFeast here with the third video in my investing terms with 10 more additional terms that you probably want to know. The first term on our list today is diversification. I mentioned this in the previous video when I was addressing ETFs and index ETFs and why you might want to use them. Essentially, diversification can be done in a couple of ways. You can diversify what you're buying and you can diversify when you're buying. So diversifying what you're buying can be accomplished with a few ETFs where you invest some in one country, some in another, or you invest in multiple sectors, or you can just do it with stocks if you'd like to, where you buy a wide variety of stocks. If you wanted to diversify what you're holding, though, you really want to look at various market sectors and time frames. Sometimes buying things over time produces a different return yield on what you're investing. And we'll get into that a little bit more in a coming slide. But for now, let's talk about market sectors. These are parts of an economy that produce similar things. We're talking things like energy, utilities, healthcare, and financials. For a long time, energy almost exclusively referred to oil. It's getting a little more diversified even within that sector because solar and wind and recently nuclear. I mean, it's September 10th and the uranium prices are skyrocketing because of thoughts that the current administration might promote nuclear as a green energy initiative. We're going to see how that goes in the coming weeks. It's unknown right now. But your market sectors are things you'd want to look at when you want to diversify. If you buy 3 ETFs within one market sector, you're obviously not diversified. You want to buy ETFs that cover multiple market sectors or have holdings that cover multiple market sectors so that if one sector suffers, ideally the other ones do not. Dollar cost averaging. This is diversifying your holdings in relation to time. What you essentially do when you're dollar cost averaging is consistently investing in the same things on a set schedule in roughly the same amounts. So you might say, all right, every month I'm going to invest $1,000 in my Roth IRA and distribute that in whatever way you'd like across multiple funds. Okay, it's a good thing to do. Now, what dollar cost averaging lets you do is kind of produce a different growth pattern in your portfolio. And how it does that is if we look at this chart and we view every one of these vertical lines as 1 month and say, all right, I'm going to invest $1,000 here. Okay, it's grown a little bit. Invest $1,000 here. It's grown a little bit. Invest $1,000 here. Well, this growth is quite steep. And you invest on the way down. You don't really pay attention because you've got confidence in what you're investing in. Then that allows you to take advantage of recovery periods. So this might be a market correction. These happen every so often where the market just goes in a downturn. And people who are buying during that time will benefit tremendously from growth following that downturn. So dollar cost averaging lets you take advantage of things like a triple leveraged ETF. And I can do a separate video on that. But essentially, you don't want to hold triple leverage ETF if you buy up front and never buy anymore because your holding will actually decline in value. But if you dollar cost average it, you'll experience growth greater than the underlying non-leveraged ETF. Now let's come around to long. Long being the opposite of short in everyday discussion and in trading. Long is being on the buying side of things. Not necessarily bullish. They're not synonymous because you can be long on a bearish holding. You can buy a inverse ETF which goes up when the rest of the market is going down, or you can buy a put option which goes up when the underlying goes down. So being long just means you're on the buy side of something. Conversely, being short is being on the sell side of something. It means you're selling stock that you don't have, or you're selling a contract to somebody in the form of an option or a future. If you play long and short very well, you can benefit under essentially any market condition. I mean, markets go up or down, and if you play these right, you can benefit on the way up and benefit on the way down, or even when the market trades sideways. Like if there's not a lot of movement, which would be really difficult to benefit from if you only went long on something. But if there's not a lot of movement up and down, being short on things can generate you some income. And I'm going to get into that more when we get to options trading videos. We've got one more just general term video, then we'll get into options trading. So the next two terms are bid and ask. I put them on the same slide because they go well together. It's kind of hard to discuss them separately. The bid is the highest price a buyer will pay for something. So this is what you as a buyer would say, this is what this is worth to me, whatever it is. It can be stock XYZ, and you say, oh, your stock XYZ is worth $5 to me. The ask is the lowest price a seller will accept for something. So the seller might say, all right, XYZ is worth $5.50 to me. Notice that there's a difference there. There's a 50-cent gap there. You're going to have to overcome that if you want to actually make a trade. So what often happens is people meet in the middle. Okay? Now this gap in between the bid-ask is called the bid-ask spread. This is where your choice in broker becomes more important because some brokers do better at bridging the gap between the bid-ask spread for you, getting you a slightly better deal. So it's important to note that the bid and the ask are never going to be the same number, because if they were, a lot of trades would rapidly occur and the bid-ask spread would be reestablished. Now, what determines your bid-ask spread is essentially how much or how often something is traded in a period of time, the volume of trades across a period of time. So something like SPY, which is heavily traded, tends to have a bid-ask spread of about 1 cent on shares, and probably no more than 5 cents on an options contract. So it's a very tight bid-ask spread. So it's easy for you to bridge that gap and not lose a lot of money to the spread. But you'll notice on something with a larger bid-ask spread, like I sometimes trade in a ticker STAR, STAR, has a wider bid-ask spread. And let's say the spread is 50 cents on an options contract. Well, I might have to go past the halfway point to actually buy an option contract, or past the halfway point to sell an option contract. So then it can show up as an immediate loss of the difference between the halfway point and the bid or the ask, depending on what side I'm on. So it's good to pay attention to the bid-ask spread to ensure that you're getting a good deal and what you're trading is traded frequently enough that you can buy it and sell it without losing some value to the spread. Capital gains is the profit from the exchange of a security. So if you buy XYZ for $100, then turn around next week and sell it for $120, your capital gains is the difference between what you sold it at and what you bought it at. Your capital gain there would be about $20. So your capital gains also refers to a tax, and the tax rate of capital gains depends on how long you hold something for and your income. So if you hold something for over 1 year, it will, when you sell it, long-term capital gains tax will apply. Currently, the long-term capital gains tax is 20%, which is not very high. It's sort of a reward for holding something for a long period of time. It helps a lot of people when they retire to pay lower capital gains tax. Short-term capital gains tax is a little more complicated because it depends on how much you make currently. So if you buy something and then sell it in less than 1 year, the actual gain on that sale will be taxed at your tax bracket as if it was regular income. It can be pretty high, but again, you're getting taxed on profit. It's not a bad problem to have. So there's a lot of people who make a big deal out of these taxes, but having to pay a lot in taxes is not the worst problem to have, in my opinion. Yield is the interest or dividend from an investment. It is described as the payout in relation to the current price of whatever you're buying. So let's say you buy an ETF with a 10% yield, and the ETF is $10. Well, you're going to get $1 a year out of that, essentially. Now, if the ETF doubles in the next day, the yield will be 5% because it's going to be the same amount dispersed divided by a higher asset value. So your yield is kind of locked in at whatever you buy it at. It's not going to shift with these things too much, hopefully. With a bond, you're definitely locked in. With an ETF or a regular stock, your dividend yield can vary depending on how the company's doing, what they decide to do. It's good to invest in companies with a history of increasing their dividend to hopefully increase their yield percentage. These are fairly easy to find. You can look up dividend aristocrats if you're interested in that. Real estate investment trusts. So buying a house and renting a house can be prohibitively expensive, and it's a lot of work, honestly. Having managed a rental property before, it can be a real pain in the butt, especially if your tenants aren't the best. So what you can do as an alternative is in your account, you can buy shares of real estate investment trusts, just like you could buy shares in Coke or whatever stock or ETF you want. You can look up a real estate investment trust. Previously, I mentioned Star. They're a real estate investment trust that owns another real estate investment trust. And what these trusts do is they manage properties and pass on 90% of their taxable incomes in the form of dividends. Now, you may say, 90%, that's unbelievably good. And you're right, because anything that sounds unbelievably good probably is. They can reduce their taxable income by going into debt and having other recurring costs that they have to meet. And they'll do that to grow the size of their REIT. So you'll notice that the average dividend yield of a REIT about 4.3% in 2021. Now, REITs specialize in various things. So if you had a REIT that specialized in, commercial rental in 2020, it probably took a bit of a hit because people were out of the office due to COVID. Also, all through 2020 and 2021, there's been a halt on eviction of residential real estate properties, which probably didn't help your REITs that specialized in renting to regular people. If the REIT you had owned apartment buildings, there's a good chance that they experienced some difficulties collecting rent from people who are suffering financially. And while they would normally replace those people, they weren't able to. So REITs allow you to invest in real estate companies, and they get really weird. I mean, you can get REITs that have billboards. There's billboard REITs. There's cell tower REITs, which are benefiting massively from the rollout of 5G. 5G requires a lot more towers than 4G. Thank you for watching. We have one more video in our basics terms series. Then we'll move on to the terms required for options trading. And there's not as many because a lot of these terms will carry over, so it's not going to be as bad. If you have any questions or would like to request a topic, please let me know in the comments. Feel free to hit that like and subscribe button. Bye.